Well, good afternoon and welcome to Beale&Co's webinar, Managing Payment from Developers. My name is Nathan Modell and I'm a Dispute Resolution Partner in Beale&Co's Construction, Engineering and Infrastructure team. I'm pleased to be joined this afternoon by one of my colleagues, Andrew Croft, a Senior Associate from our Projects and Advisory team. Just before we get started, some housekeeping. As usual, questions can be asked during the webinar by using the interactive box on your screen. We'll do our best to respond to any questions during the webinar, but if this is not possible, we'll address any questions afterwards. Payment issues, unfortunately, are nothing new. Despite both the UK government and various professional bodies' best efforts to change the construction industry's poor reputation on payment, such as the so-called prompt payment code, the collapse of construction giants such as Carillion and the unpaid debts left behind highlight that there is still a long way to go in order to level the playing field and ensure that those involved in construction projects are protected and guaranteed to receive payment promptly for services provided. It is no wonder that the Department for Business, Energy, Industry, Strategies Small Business Survey in 2017 found that late or non-payment is a problem for 55% of small and medium-sized businesses. This figure rises to 57% for those involved in the construction industry. Recently, we've seen an increase in non-payment issues arising during construction projects for architect and engineering clients. In particular, we've seen a rise in payment issues concerning developers. Whether this has been connected to the downturn in the construction market, the availability of project finance, or Brexit uncertainty, projects have certainly been delayed, mothballed, or seen a change in direction, perhaps from commercial to residential schemes or vice versa. This generally comes with a corresponding change in the design or delivery team, which leaves behind a trail of non-payment. Whilst unfortunately there are no silver bullets and sometimes payment issues are complex, there are some practical things that you can do to maximize your prospects of receiving prompt payment from developers at the outset of your engagement, and some options available to you to maximize chances for payment later on. Whilst we cannot cover everything this afternoon, we will aim to give you an overview of some of the options available to you, in respect of which this webinar will be structured in two parts. Firstly, Andrew will give you an overview of some of the options, some of the things that make developer clients unique, and some points that should be considered when dealing with developers. He will then consider what can be done at the beginning of your engagement to put you in the best position to assist with payment issues later. In the second part, I shall be looking at some of the options available to you when payment is not forthcoming. And on that note, I'll hand over to Andrew.
Thank you very much, Nathan. As Nathan said, I'm going to look at the current payment climate a bit further and the risks of working for developers in particular. I will then move on to what I like to see as the positive side of the talk, steps you can take to improve your payment position. So, as shown on this slide, the current payment climate in the construction industry is a very difficult one. Late payment has been an industry-wide problem for some time and continues to be a key issue. For example, recent research showed that 60% of public bodies amend their standard payment provisions, and only 28% paid within 38 days, with only 24% paying within that timescale in the private sector. Recent industry and political developments, as Nathan touched on, have created further difficulties, from high-profile insolvencies such as Carillion and Interserve to the uncertainty created by the UK government playing deal or no deal with the EU. A Turner and Townsend study a few weeks ago showed confidence amongst UK contractors was at an all-time low, mainly due to declines in productivity and declines in orders. This all makes it increasingly important to agree reasonable payment terms and have a clear debt recovery process in place, as we'll discuss shortly. So, why are we focusing on developers in particular today? Developers generally have a different approach and different interests to traditional owner-occupier clients, in that their primary objective is often to flip the project for a profit. For this reason, they often take an unusual approach to procuring projects, which gives rise to a number of risks. Often projects will be carried out through shell companies or special purpose vehicles, also called SPVs, so that all the developer's risk is contained in that company. These entities may be based offshore or funded from outside the UK. This means that recovery and payment is likely to be more difficult than it would be with a traditional client, as it may involve jurisdictional issues and/or there may be no assets in England and Wales that can be recovered. Offshore funding can also mean that the project could be delayed due to issues in different jurisdictions and may result in compliance risks, as I'll discuss. Another risk of working for developers is that the SPVs that they create often have no long-term relationship with their supply chain, and so have limited interest in incentivizing the supply chain through the payment mechanism. Developers also often seek to transfer projects midway between the project, whether that's between group companies, perhaps for tax purposes, or because they've decided to sell the project after planning permission has been secured, for example. This means that the consultant and supply chain will be reliant on a new client for payment. In addition, as I'll consider shortly, often when you're working with developers, payment can be made by third parties, i.e. someone who is not the named client in the appointment. Further, as Nathan touched on, developers are more likely to either halt a project midway through or abandon it if planning is not obtained due to funding issues, or because they simply don't think the project is viable. As I mentioned, as the developer may be a one-off and resident offshore or funded offshore, there can also be a number of potential compliance issues if you don't carry out your proper checks on the developer client. As shown by the slide, a previous study reported that the UK's 20 largest developers took 56 days to pay, on average, which underlines the issue we are discussing today. So, now for what I called the positive section. What can you do to improve your payment position? Steps include, which I'll look at in more detail, being completely clear on who your client is, using the Construction Act insofar as you can, agreeing reasonable payment terms, and reviewing your invoicing arrangements. This is not necessarily rocket science, but it's very important just to have all your ducks in a row in relation to payment, particularly when working for developers. So, being clear on the identity of the client is always key, but this is particularly the case when working for developers. Obviously, at the outset, financial checks should be carried out, which may involve, for the relevant companies, checking their reported payment periods under the Reporting on Payment Practices and Performance Regulations 2017, all of which is now available online on a government website. Any risks arising from those checks should then be reflected in the fee structure if possible. In some circumstances with developers, it may not be completely clear who the client actually is, as often third-party consultants may be used to procure appointments, and/or, as I mentioned, payment may be made by a different party to that who's named in the appointment, or the party that is actually named in the appointment may not be who you think it is. It seems simple to say all this, but we do have actual experiences of ambiguity as to the client, causing difficulties in recovering payment from developers. So it is very important to get your ducks in a row, as I said. Needless to say, the best position will be if the client named in the appointment and paying your fee is the developer entity that you have a long-term relationship with and that has the most assets. It is increasingly common for developers to make, or want a right to make, payment through third-party entities. And I will show you a real-life example of drafting which reflects this shortly. Such arrangements create ambiguity about your client, and they may mean, unless the drafting in the contract is completely clear, that the third party becomes your client as a matter of fact. In addition, one reason why your client is wanting to pay through a third party may be because the named client, probably an SPV, has no or very limited assets. So there are obvious risks of such arrangements. Payment by third parties should be avoided if possible. If it cannot be avoided, the appointment should make clear that both the client and the third party are jointly and severally liable for failure to pay your fees under the appointment. In addition, the liability position in terms of the consultant under the appointment should also be clear as between the consultant and the third party paying, i.e. collateral warranty should be avoided if possible. Another way of improving your payment position is through the Construction Act. The Construction Act has been in place since 1996 and is a mandatory payment regime which I will consider on the next slide. Amongst other things, the Construction Act makes pay when paid enforceable and includes very useful remedies for non-payment, such as suspension and adjudication, as Nathan will discuss. The key points to highlight are that to make the best use of the Construction Act, it needs to be reflected in your invoicing and debt recovery processes and in your appointments. Otherwise, it can be more difficult to take advantage of the useful tools it makes available. In addition, the remedies under the Construction Act, such as the right to suspend and adjudicate, generally require you to act promptly to make the most of them. And this is particularly the case with developer clients, as often the client may have limited shelf life and may not have many assets once the project is completed. The mandatory payment regime under the Construction Act will be applied into all construction contracts. However, if a construction contract does not include payment provisions, the way that scheme is applied is through the scheme for construction contracts. The scheme for construction contracts is generally very complex and difficult to apply. So for that reason, it is very important to always agree and include Act-compliant payment provisions in your appointment at the outset so that your payment entitlement is clear. So, here's the flowchart I mentioned showing how the Construction Act payment process works in practice. In this case, the consultant's invoice is the payment notice. The sums stated as due in the consultant's invoice are due 7 days from the date of the invoice, and the final date for payment of those sums is 21 days after the invoice date. The client must pay the sum claimed in the invoice, unless it serves a pay less notice 7 days before the final date for payment. As I said, this is an example, but it just shows you how the tools required by the Construction Act work in practice. The key points that should apply on any appointment are that there is a due date, a final date for payment, and a period before the final date for payment during which the client must serve a pay less notice. Otherwise, the client has to pay the amount claimed or stated as due in the payment notice. So, the Construction Act can be a very useful tool for providing payment certainty. In addition to Construction Act compliant terms, it is also important that reasonable payment terms are agreed. Firstly, given the uncertainty arising from the scheme, as I mentioned earlier, Act compliant payment terms should be in place as early as possible, perhaps by attaching standard terms to a fee proposal at the outset of a project. Where possible, these terms should state that the invoice is the payment notice and therefore triggers the start of the payment process. Just going back to the example, it is possible under the Act for contracts to provide that the payment notice is submitted by the client after the consultant or contractor has submitted an application for payment. The risk of this approach is that it gives the clients two bites at the cherry, in that they can submit the payment notice after receiving the invoice or application for payment, and then have a right to submit a pay less notice. So it's obviously beneficial for the invoice to be the payment notice where possible. In addition to having Act compliant payment rate mechanism in place at the outset, it's also important that you are clear as early as possible in relation to how often you can submit invoices on a project. This should be monthly where possible, and also have a clear payment period from submission of the invoice, 30 days where possible. In addition, when negotiating appointments, a number of factors should be borne into account and potential risks, which I'll now run through. Firstly, additional requirements for payment to become due should be avoided. For example, I have seen appointments requiring submission of KPI performance reports as a precondition to sums becoming due, essentially requiring the consultant to submit performance reports every month, and they won't be paid for minor failure to report. That is obviously extremely onerous and should be resisted. It is also important to front load payment wherever possible for ease of cash flow, to limit the risk of delay payment further down the line. This is particularly the case on international projects, where advance payments are fairly commonplace. Other key points to bear in mind when negotiating appointments are to avoid and/or manage conditions precedent to payment being due. If a condition precedent is not complied with, no sums will be due, so they should be avoided where possible. Common examples of a condition precedent would be the provision of a collateral warranty when requested within the required timescales. That may be something that could be managed, but often there are much more onerous condition precedents than that. As I said, conditions precedent should be avoided. In addition, the timescales for payment should also be clear. This is linked with the invoice submission date point that I mentioned earlier. You should avoid payment being conditional on completion of each stage, or as is common on early stage appointments, of it being conditional on granting of planning permission, which would be completely outside the consultant's control. Instead, you should be entitled to invoice monthly for an amount which reflects the percentage of completion of the instalment agreed for each stage, if instalments are agreed. Or in the case of planning, the instalment agreed for submission of planning. In addition, if you're only appointed in relation to planning and you're unable to obtain planning, or the client's unable to obtain planning, there should be a fallback position whereby the consultant is still entitled to payment of an amount even if planning isn't obtained. In addition, a clear entitlement to additional fees should be requested. In particular, a right to increase the fee if additional or varied services are required, or if services are prolonged due to circumstances outside your control, should be requested. Often, bespoke appointments will state that the consultant is only entitled to additional payment where additional or varied services are instructed by the client. However, there will be circumstances where a consultant has to provide additional or varied services due to circumstances outside its control, so such rights are very important. In addition, in the current political and regulatory climate, we also suggest considering including a right for additional payment if additional or varied services are required, or the services are delayed or prolonged due to Brexit, due to changes in law, and/or any outcomes from the Hackett review, which could result in significant regulatory change. It will obviously not always be possible to agree such wide rights to additional payment, but that can be useful as a starting point, and in particular in standard terms. Finally, in addition to the right to suspension mentioned, which is implied under the Construction Act, a right to terminate for prolonged non-payment can also be very useful. For example, if payment is outstanding for, say, over 30 days, an express right to terminate. In addition, a contractual right to suspend, which reflects the Construction Act, is also useful. These can either be used as a stick to encourage payment if it's not made when required, and/or can give you a way out of the appointment. So, I will now look at some real-life examples of good and bad payment terms that we are seeing in the market. Starting with a standard form and the recently published RIBA Professional Services Contract 2018, published last year. This provides that the due date is the date of the architect's invoice, which is the position I suggested earlier, and also sets out that the final date for payment is 14 days after that date. These are reasonable payment terms which reflect the Construction Act and are an example of how Construction Act drafting works in practice. Now, some bad examples. Firstly, this clause required that any application for payment or payment notice was headed in red capitals, saying that this is a payee notice and failure to respond may result in the following notified sum becoming due not becoming due and payable. In addition, the payment notice had to be sent in duplicate to the courier, by courier, to 2 different places, and any failure to comply with these detailed requirements made the payee notice invalid. This is clearly drafting intended to create an additional hurdle for payment to become due to the requirements of the Construction Act, and these should be avoided whenever possible. A further example of bad payment provisions is now set up on this slide. The concerns about this include the reference to conditions precedent, which, if they have not been complied with, the payment notice or the obligation to pay will not be effective. In addition, there's an express requirement that any application for payment is submitted on the specific dates agreed as set out in the schedule, so any other date and the application for payment will not be valid. Finally, this appointment included maximum entitlements to payment for each stage, so that if the sums applied for any particular stage exceeded that maximum entitlement, no further payment would be made. Again, these are all things that should be avoided in payment mechanisms wherever possible. Finally, on this slide, there are some examples of a right for third parties to make payment, which does not include the joint and several liability I mentioned previously, and is just a general right for the client to have another member of its group make payment on its behalf. In addition, the final clause is a condition precedent, basically stating that no payment will be made in relation to a stage unless written approval to proceed with that stage has been confirmed. As I mentioned, conditions precedent mean that there's no entitlement to payment until the condition precedent is satisfied, and technical requirements such as this should be avoided if possible. So, outside of the appointment, it's also important that the Construction Act and your approach to recovering payment is reflected in your invoicing arrangements. Many invoices that we see will just include standard statements such as payment is due in 28 days, which does not reflect the actual payment period in the appointment, and therefore the invoice creates inconsistency. In addition, the invoice may not state the amount considered to be due or the basis on which that is calculated, as required by the Construction Act for an invoice to be a valid payment notice. Invoices which either are inconsistent with the appointment and or do not clearly set out what the Construction Act requires a payment notice to set out may make recovering payment more difficult or delay payment. It is therefore very important that any invoice or application for payment clearly reflects the Construction Act and the appointment terms and payment provisions insofar as possible. This is not necessarily easy where a number of different appointments are entered into at the same time and are ongoing, but it is really important that as much as you can, the invoicing process is tied in with the project team and also that the submission of an invoice is a trigger for your debt recovery process, so that you are aware as soon as an invoice is not paid within the agreed time and can take action. So, what do you need to include in an invoice to make it a valid payment notice? The Construction Act quite generally refers to a payment notice stating the sum considered to be due and the basis on which that is calculated, which is not particularly clear. The test for a payment notice has been described by some as an elephant test, which is why we've got a nice picture of an elephant on the slide. This is because a payment notice is difficult to describe in words, but you know what one is when you see it. It is clear from case law that a payment notice must follow the Act, the Construction Act, in form and intent, and there has been quite a lot of case law in the last 5 years in relation to whether something was a valid payment notice or not. The courts have generally set quite a high bar for something to be a payment notice, mainly because there are onerous consequences for the payer if a payment notice is issued and is valid when the payer wasn't aware of it, in that if they don't submit a pay less notice within time, the payer has to pay the amount claimed in the payment notice. Example of this fairly high threshold include, as set out on the slide, a final account valuation was not considered to be a valid payment notice because it didn't state the sums considered to be due, it just valued the work that had been undertaken to date, which is a very technical difference, you'd think, which could have been easily corrected, but that's the way the courts have interpreted the Construction Act. As is set out in the quote, if you intend to serve a payee's notice or a payment notice, it's important that you're clear that that is exactly what you're doing. So, setting out at the top of any invoice or application for payment that it is a payment notice under the Construction Act, and clearly linking that to the requirements of the Construction Act, i.e. stating the sum considered to be due and the basis on which that is calculated. So, that's the end of my part of the talk. I'm now going to pass over to Nathan.
Thank you, Andrew. Some useful points to note there. The quote there up on the screen is from Sir Francis Bacon in 1624. Money is like muck, not good except it be spread. Now, Sir Francis obviously wasn't speaking about non-paying developers of his time, but nonetheless his words would be recommended reading for any developer today. Unfortunately, as I mentioned, payment issues are nothing new and there is no silver bullet. As Andrew has identified, there are some special factors about developers which mean it is important to monitor payment. If you're able to follow the advice that Andrew has provided, you will have a number of tools available to you. There are also a number of default statutory and other options which Andrew touched on briefly. If you followed Andrew's advice and you've been able to negotiate good terms with your developer clients, the first thing to do is to ensure that you follow the terms of your appointment. This is in respect of both providing any deliverables required under the appointment, but also in respect of submitting those payment applications in the appropriate format and at the appropriate time, as Andrew described. As Andrew touched on, we often see that invoices or payment notices issued on disputes do not refer to the agreed appointment terms or payment provisions in respect of content or timing. As well as the points as Andrew pointed out, it's useful also to describe on any payment notices the work that's been done or the stage of work to which the invoice or payment notice relates. It's also important, if you can, to identify any changes or instructions, recording in what form and when those instructions were given. If for whatever reason the appointment has not been agreed or executed, consider referring to the form of appointment that was discussed, or any fee proposal that has been given or accepted. If there are no terms agreed, also consider referring to your standard terms and conditions if possible. This may assist if a dispute arises later. If none of this is possible, the default position is usually that the Construction Act applies, providing for the default payment regime which Andrew has discussed. Now, a good proportion of disputes that we see also arise because a consultant has been asked to provide additional advice or services which were not within their original scope. This generally leads to one of two problems. The first is in respect of problems with payment for those additional services, and the second is in respect of an additional risk as to liability that arises from that change or instruction. For both of these reasons, it is important to ensure that good and detailed contemporaneous records are made and that any change in scope and resulting fee are adequately recorded and confirmed in writing, hence the need to keep good records. Ensure also that you comply with clauses in respect of variations and additional work and continue to operate your appointment at all times. These are simple points, but they will assist if a dispute arises later. Recognise and identify payment issues when they arise and take the appropriate action. Everyone has clients who do not pay promptly, even, believe it or not, us lawyers. However, as Andrew has identified, developer clients can be different to other clients, and far too often we see disputes arise on construction projects where the level of fee outstanding has become substantial. As with many things, the options available to you are best deployed at the right time. Hopefully, some of you listening will remember the Bob Hoskins British Telecom advertising campaign of the 1990s, "It's Good to Talk," or perhaps not, and perhaps it's just my age showing. Provided you followed the terms of your appointment or have complied with the statutory provisions of the Construction Act, before you contemplate escalating things further, at the first sign of any non-payment issues, consider whether it's possible to pick up the phone or arrange a meet with your developer client to speak about payment and find out what's holding things up. There is potentially a straightforward reason why payment has not been made, and sometimes this is because the client is not happy with something that has happened that can be quickly resolved, or for a genuine and temporary reason which can then be monitored before further work is done or payment notice is issued. If this is the case, then record what has been discussed with your client and communicate it in writing. Agree a way forward and monitor that the situation does not continue. If appropriate, also schedule in regular further payment meetings with your client. If any concessions are made in respect of fees, reserve the right to recover the full sum owed if payment isn't agreed within the agreed time frame. Remember also to withdraw any formal offers to accept less. If payment is not received under the terms of what you've agreed, then ensure the offer is formally withdrawn. Whilst these seem like simple steps, sometimes just discussing the issue is enough to unlock payment. However, on many occasions it isn't, so what else can you do? Well, Andrew has spoken briefly about the Construction Act, so I'm not going to go into too much detail. On the screen there, you've got some important sections of the Act which determine whether it will apply to your appointment. In most cases, appointments in the UK with developer clients will fall under the remit of the Act. There are some important exclusions, such as operations, construction contracts dealing with oil and gas, for example, but these aren't necessarily relevant to developers. However, Section 106 of the Act probably is relevant, and that defines what's known as a residential occupier. Now, a residential occupier is defined as concerning works which principally relate to operations on a dwelling which one of the parties to the contract occupies or intends to occupy as his residence. This may well apply to some developer clients, so it's best to check if this is the position. There are also what's known as hybrid contracts, which may involve elements which fall within the scope of the Construction Act and elements which do not. Again, the case listed on the screen there, C. Spencer Limited and MW High Tech Projects Limited, UK Limited, sorry, is probably not relevant to developer clients as it concerns the construction of a power plant. However, the case does highlight the fact that there is a possibility for these hybrid contracts to exist, and it's important to remember that some elements of an appointment with a developer may fall within the Act and others may not. So again, it's worth checking. As Andrew outlined, the Construction Act puts in place a default regime in terms of allowing for interim, periodic or stage payments. The Act also includes provisions for due and final dates for payment, as well as the requirement for valid payment and pay less notices. Under the Construction Act, the remedy for non-payment is adjudication, which we'll touch on a bit later on. So, after that recap of the Construction Act, if you have submitted your invoices, payment notices on time, and it hasn't been possible to discuss and agree a resolution to any non-payment issues, then before we look at adjudication, consider whether suspension is an option. For an architect, for example, a threat to suspend services may be most effective prior to an important planning meeting or a key stage in the design development when the drawings are being used, rather than at the end of the construction phase, so timing is important. It's also necessary to consider whether there is any provision in your appointment to suspend your services for non-payment, and if you have the opportunity to include a provision as Andrew described, you should do so in your standard terms and conditions or the appointments that you're negotiating. You will of course need to consider under what circumstances you are entitled to suspend services under your appointment and comply with any notice provisions contained therein. You do also have a statutory right under the Construction Act to suspend for non-payment under section 112. Under this section, you are required to give at least 7 days notice of the intention to suspend your services before actually doing so. In addition, you may refer to the fact that section 112 also allows any period of suspension to be added to the time for performance of the services if this is relevant. In addition to the suspension of services, you may also have the contractual right to suspend your copyright license in any drawings or information provided. Suspension of copyright, of course, will depend on whether you have a right under your appointment, for example, if under the RIBA terms. Again, while suspension of services may be useful during the design stages, suspension of copyright during the construction phase or during the marketing of a property might be persuasive if you are entitled to do so and extensive use of copyrighted material is made. Withholding of certificates for non-payment may also be an option if you are required to provide these, although again it's necessary to check whether your appointment allows you to do so and under what conditions. There are a couple of warnings in respect of suspension generally. Firstly, while the threat can be powerful, actually following through and suspending can leave you exposed to damages if you are not entitled to suspend or have not followed the terms of the appointment very carefully. If you are considering this option but are unsure, the best thing to do is to take legal advice. Secondly, repeated threats to suspend are unlikely to have the desired effect, so use the threat carefully and be prepared to follow through if necessary. In short, don't be afraid of suspension and be prepared to use it if necessary. If suspension still doesn't work, what else can you do? Well, the nuclear option is termination. Under the terms of your appointment or standard terms and conditions, you will no doubt have a provision to serve notice to terminate, and hopefully we'll have provisions setting out what payment is due on termination. There is also a common law right to terminate, and you may, in certain circumstances, be entitled to recover damages in addition to any fees owed. However, as with suspension, it is likely that you will need to terminate for the right reasons and at the right time by providing the correct notice. Termination may have serious consequences and again may expose you to potential claims for damages if not done properly. Therefore, again, another plug for the lawyers, best to seek legal advice if you're considering this option. Can you issue a statutory demand and follow up with a winding up petition? The answer is, it depends. Now, we've put a big warning sign next to this option for a reason. A statutory demand is a formal written demand for payment within 21 days before a winding up petition can be made at court for the company in question to be wound up on the basis that it cannot pay its debts. This is a serious procedure and one which can lead to serious consequences for a company, including having bank accounts frozen and debts called in. In order to issue a statutory demand, the debt owed must be £750, and importantly, the debt must not be disputed. As to timing, serving a statutory demand during a live project, if you're able to do so, will certainly get you noticed, but it may also damage relations seriously. There are also a number of issues to consider. The developer must be based in the UK for the procedure to be effective, and whilst the statutory demand can be successful in getting your attention, following through and proceeding to present a winding up petition is expensive, and ultimately, even if it is successful, it is likely that you will be an unsecured creditor and unlikely to recover the majority of your fees. As I touched on briefly as well, taking this action could also jeopardise the whole project as a whole and not make you very popular with the other design team members. In addition, it's important to note that in respect of the debt not being disputed, if the provisions of the Construction Act do apply, which is likely, then because a dispute can be adjudicated at any time, it may be argued that adjudication is the correct procedure to follow and not making a statutory demand. Furthermore, the developer may issue an injunction to prevent you submitting a winding up petition. If they're successful in this application, costs may be awarded against you, which could be substantial. Again, this is why we put the warning symbol there. Statutory demands can be useful tool in the right circumstances, however, care needs to be taken when considering using them. In terms of dispute resolution clauses in your appointment, what we're increasingly seeing is escalating dispute resolution clauses, which, for example, require you to give notice of a dispute before a meeting can take place, followed by mediation before more formal dispute procedures can be followed. If this is the case, you may have to follow the procedure carefully to escalate your fee dispute, and in some instances, you might lose the right to do so. This is with the exception of adjudication. It is likely that your appointment will contain either provision for adjudication, court proceedings, or arbitration. Now, I don't intend to say too much about court proceedings or arbitration, you'll be pleased to hear. These are webinar sessions in their own right, and if this route is required, it's more than likely that you will require serious legal assistance at that stage. However, we will cover adjudication in a little more detail on the next slide. However, the final point for this slide is at the bottom there, you'll see counterclaim. More often than not, when payment issues are escalated with developer clients or others, they will be met with allegations of poor performance or professional negligence. For this reason, it is important to keep your broker and insurers up to date if such allegations are made. So, even if your appointment doesn't include a specific provision, as long as the Construction Act applies, you'll have a statutory right to adjudicate, and therefore is an important process to be aware of. So, just to recap, what is adjudication? Adjudication is an interim dispute resolution method designed to provide a decision that is binding on the parties until the dispute can be determined by court proceedings, arbitration, or settlement. Adjudication aims to provide a timely and efficient resolution to disputes, and in particular fee disputes. When can adjudication be used? As discussed earlier on, under the Construction Act, a party can give notice of a dispute at any time of his intention to refer a dispute to adjudication. The dispute must have crystallised, and what this means is that the claim must have been presented to the other party before the start of the adjudication, and they must have refused to pay in respect of that dispute. In terms of the outcomes, the decision of an adjudicator is binding until the dispute is finally determined by legal proceedings, arbitration, or agreement. There are very limited grounds upon which an adjudicator's decision can be set aside. One example is where an adjudicator is found to have breached the rules of natural justice. Now, this may occur if an adjudicator fails to act impartially or where there has been some form of procedural irregularity. A party may make an application for judicial review of the adjudication decision within 30 days of that decision. Subject to any alternative agreement between the parties, in adjudication, each party bears their own costs of the adjudication. Now, adjudication has developed in the UK into its own industry. However, it was intended that parties to construction contracts should be able to use adjudication themselves to enforce payment. If yours is a simple fee dispute, there is no reason why you cannot adjudicate yourself. Just to turn to some final thoughts. Follow the terms of your appointment, that you do, if you do have one in place, and ensure that detailed contemporaneous documents are retained. As Andrew identified, developers have some unique characteristics, so it's important to recognise and identify payment issues when they arise and not to ignore them. Channel your inner Bob Hoskins and remember it's good to talk. If you have the opportunity, speak to your developer client and find out what's holding up payment. Remember, if this doesn't work, timing and leverage are key. Threatening to suspend at the end of a project is unlikely to yield a result, whereas at an appropriate time, it will provide you with good leverage. Consider establishing an internal debt recovery procedure on all projects when non-payment issues are identified. Ensure that your whole team knows what steps to take under each appointment and when to escalate payment issues before they become critical. If you wish to discuss any payment issues or anything we've discussed this afternoon, please feel free to contact either Andrew or myself. All that remains is for me to thank you for joining us and to remind you of our next webinar, Public Contract Regulations 2015, a refresher, which takes place on the 13th of November. There's a link up on the screen there for you to register for that session. Thank you and good afternoon.